Good morning and good afternoon, everyone. Welcome and thank you for joining us today. I'm Prashant, a product expert at Zoho Books, and I'll be your moderator for today's session. We are here to explore on how to save more on taxes this business season for your business, and and this is particularly very relevant topic at this point of time in this country because year end is when all the business gets with respect to tax. And I'm joined by these two lovely ladies who are highly experienced in this field, who will be taking us over this session. And I'll leave the stage for them to introduce themselves and take over this. But before that, I'd just like to give a quick overview of our webinar platform. If in case this is the first time you are joining on Zoho webinars, these two bubbles are like very important to you. The first one is the chat one, where you can leave your comments for us. And the question mark is where you leave all your questions, and it'll be my responsibility to ensure all your questions are answered by our two experts here. So let's jump directly into this discussion. And first, I'd like to invite Purnima to give a quick introduction about herself.
Thank you, Prashant. Good morning and good afternoon to everyone. Thank you for joining us today. I'm very excited to be part of this webinar today. My name is Purnima. I head the growth of Zoho Finance and Operations Suite in the North America region. I have been with Zoho for almost 18 years. I started my career at Zoho as a developer back in 2007, and I had the privilege of holding multiple roles, including engineering manager, product manager, and regional managers. And in addition to the current responsibility, I also spearhead the data privacy and compliance for the industry specific compliance for Zoho Finance products. And outside of work, I'm a mom of two young kids and I love spending time with them. And here's my QR code. If you want to connect with me on LinkedIn, please go ahead. This
Thank
is
you.
all about me, and I'm very excited to share a lot of insights with you today.
Thank you very much, Purnima. Over to you, Jayanti.
Hey, thanks, Purnima. Thanks, Prashant. Hello, everyone. Good morning, good afternoon. Depends on which part of the country you're calling from. So my name is Jayanti Ganapathy. I do go by Jay. I own an accounting firm named FinAccurate, based in Boston, Massachusetts. So we work with small business owners. We provide bookkeeping, CFO services, tax planning, and tax preparation services. I'm a certified accountant, cost accountant, and a management accountant, and also have a certification in SAP ERP. And here most of my education are from India, but when I moved to US 15 years ago, I started exploring tax strategies, US tax strategies. So I have a certification in US specific tax strategies, MSCTA, and I also are working towards my path towards USCPA and certified tax coach as well. So those are all my education. I worked in three different countries. I started in India, worked for a multinational company for 11 years. I moved to Australia as a financial accountant and came to United States almost 15 years ago as part of M&A PMI post-migration unit. And after working for the multinational company for 11 years, I quit my job to start my own venture. That's my firm, accounting firm, FinAccurate, based in Massachusetts. We work closely with the small business owners. Our mission for FinAccurate is to help small business owners save taxes. And we are working on a mission to save $3 billion in taxes for our clients. So that's my lifetime mission as part of FinAccurate. So I'm based in Boston. I have two boys. They are 5 and 6 years old. So I enjoy spending time with them as well. So next slide, Prashant. That's gives the overview of my education. Yeah, basically started as a bachelor's in commerce at my undergrad. I'm a chartered accountant from India, which is 20 times harder, I would say, compared to a US CPA. Then the rest of my education is all like cost accountant, company secretaryship. I also have a executive MBA done in Boston here, and MSCTA, part of Mark J. Kohler, who is #1 tax strategist in the United States. So I'm part of his Tax Pro network and a Tax Pro partner. So we help US business through that network as well. I'm also enrolled IRS enrolled agent, studied US taxation and certified in that, and working towards my US CPA. And I'm also a certified tax coach. So Okay, next slide. So let's get to the topic for today, the core topic. So we are going to cover 12 year-end tax saving strategies, though there are so many, but these are the core given the time frame we are in now, December 12th. So I focused on what you can still do between now and December 31st. So we will be going over each one of these aspects in detail. Let's get to the first one. The next slide, Prashant. So first, get out of the startup mode. So if you started a small business this year, and sometimes this year it could be a side hustle or a proper LLC that you have formed, but you are only incurring expenses and haven't made a sale, it's highly critical for you to make a sale, even if it's like $1. What that does from a tax perspective is, so as a startup, you would have had startup related expenses like research, marketing, forming the LLC. All of those costs typically will only be capitalized and amortized over a period of time, 15 years, but until you have your first sale. So the moment you have your first sale, even if it's $1, you get to deduct up to $5,000 in startup cost in that first year. So when we say 5,000 up to $5,000, it's not like a $5,000 deduction you get automatically. Let's say you only spent $3,000 in this year starting your business, so you get $3,000 as an expense deduction the moment you make your first sale. So if you go spend up to $5,000, 5,000 is the ceiling. So you will get to go take $5,000 as a deduction, even if the sale was $1 or as a minimum. So if you don't have that sale, you will not be eligible to take that $5,000 as a deduction in year one. So that is why it's critical to have your, if you started your business this year and haven't made a sale, even if you want to sell it to your friend to make it look formal in your books, please do it. That gets you 5,000 in expense reduction, which will lower your taxable income for the year. Which will, if you have a sale, any expense related to the sale, also you will be able to deduct in year one. So those are the reasons why you want to, as quickly as possible, getting out of the startup mode. So other things related to between now and end of the year, if you formed a business and an LLC, there was also recent beneficial ownership interest filings, which it was a FinCEN requirement. Every LLC has to file by January 1st, 2025. But earlier this week, there was a ban on enforcing the beneficial ownership reporting. So it's no longer a requirement to file by January 1st, but we are still encouraging our clients just to be on the safer side, voluntarily go and file your beneficial ownership report, which is still the January 1st, 2025. So other thing you can look at is if you have started an LLC this year or a few years ago, but you're not doing any activity there, you should take a look at your list of businesses and start cleaning it up. That way you are not continuing with LLC, filing for the annual registration with your state and paying the annual fees. So this is a good time for you to take a look at your inactive LLCs and make sure if you still need them. If you don't need them, inactivate them so you are not continuing to pay for the LLC fees, organization cost, and unnecessary franchise tax in some states as well. Yep. Second slide. Next slide. So this is a important one, and there is still time to do this. If you are if you have a limited liability corporation, which is the LLC, and you're 100% owner of it, which means it's a single member LLC, and if your business is making net 40,000 in profit or more this year, as if you remain as a single member LLC for the rest of the year, you will be overpaying in federal taxes. So what that means is, as a single member LLC, 100% owner, you will be reporting your income and expenses as part of your personal tax return under Schedule C. So the moment you, as part of the Schedule C, in addition to the federal taxes, you're also paying something called a self-employment taxes, which is your social security and Medicare taxes to the federal and state. So if you continue to report as a Schedule C and you're making more than 40,000, you will be overpaying on the self-employment taxes. So that the option that you have to save on the self-employment is to convert your LLC or even a C corp. See if you want to remain as a C corp, the best entity structure that's out there from a tax perspective is to convert into an S corporation. So you don't want to go change your entity structure from an LLC to an S corp. There is something called the election that you can do with IRS. So you can remain as an LLC. Nothing needs to be changed from an operational perspective. You file a form 2553 with IRS, requesting IRS to treat your LLC as an S corporation. So it's called S corp election, and you're not converting your entity structure from an LLC to an S corp. Once you do that, now the corporation is separate from you as an individual. So then you could draw a W-2 from your S corporation. And let's say you made 100,000 this year in net profit, not the gross income. After all of your expenses, let's say you made 100,000 this year. So when you move it to an S corporation, then now you are an employee of the organization and you are supposed to take a payroll from the S corporation. So typically we say if you made 100,000 in net profit, 30 to 40% you want to take it as a W-2, and the remaining amount will be considered as a distribution, profit distribution. So when you split that between a W-2 and a distribution, so you are only paying self-employment taxes to the extent of the W-2 that you're taking. Let's say out of the 100,000, 40,000 you take it as a W-2 wage. Now the 60,000 you take it as a distribution. Now on the 60,000, you are not paying a self-employment taxes on that. So the federal self-employment, typically both the employee and employer portion is about 15.3%. So what you're really saving is 15.3% on the 60,000, which is a little over $9,000 just by doing the switch from an LLC and electing to be treated as an S corporation. So why retroactive is the timeline with IRS to request your LLC to be treated as an S corporation is 75 days from the beginning of the year. Say for year 2024, you should have filed this election form by March 15, 2024. So that's considered a regular election, but IRS allows something called retroactive S election. This is a revenue provision that IRS allows every business owners to take it. So which says that if you miss the original deadline for valid reasons, say you relied on your accountant, they didn't tell you about this, so you missed it, but then you treated your corporation as if it was a S corporation, you ran your payroll and everything, you can ask IRS to treat your LLC as an S corporation going back to January 1, 2024, even if you file the election form now. So with that, so now we are December 12th. Between now and December 31st, you can still make that election. And if so far in this year, if you have not run a payroll, between now and end of the year is the time for you to look at how much net profit did I make this year from the business. Is it more than 40,000? If yes, then go ahead and set up a payroll for yourself, run the payroll, file the form of 2553 with IRS requesting your LLC to be treated as an S corp effective January 1, 2024. You obviously have to give reason why you missed it, and most of the time you will get an approval from IRS. Typically, the processing time can go anywhere between 2 to 6 months, but you should still be safe to go ahead and file your S corp tax return by March 15, 2025, treating your organization as an S corporation. So through this process, you're literally saving just on a 100K net profit, you save about now $9,000 to $10,000 just on the federal taxes. Yep, next slide.
All right. Jayanti, before we move to the next one, there are a couple of questions on this one as well as the previous one already. And I thought it would be right if you could answer them now so that people could make use of it. Shall I? Okay. Do you want to check the questions? There's one from Kenneth for this one.
Okay, one second. Where do I see it?
Or I can just
Yes, I see it. Is that 5K deduction for a sale in year one? What if first sale is in year two? So yeah, if the first sale happened in year two, you will only be able to take the deduction in the year when you make that first sale. Even if it's year two, it's going to be the year you make the sale. That's the year is called the first year. So you will be able to take the deduction only in year two.
Got it. And then there's one in the
So the year
chat
two
window
sale.
also. So Kenneth had asked one for this about your point number 2, whether you need to do it online or you have to mail or fax the SCOP election.
So there is a fax option. So that's what we typically do for our clients. So yeah, fax, I would say highly recommend it. We have been doing this for our clients. IRS receives it and it will be perfectly approved. I wouldn't mail it because mailing takes longer and then there is no guarantee. The 6 months I mentioned is only if you faxed it. Sometimes if you paper filed it, I don't even know how long it will take. Maybe it's can take even a year. So I would highly recommend. There is a fax number. So if you download Form 2553, depends on where your business is located based on your state, there will be a fax number that you can fax it to. Oh yes. So yeah, you can look up the form number is 2553. Yes. Needs to be mailed or fax. You can do both, but my recommendation is fax. Can you please share the recording? Okay.
Yeah, those were the questions.
File with, yeah, that you could also e-file with tax return. What we typically do is we fax it and we also e-file it to be on the safer side. There's no harm in doing it twice, but just to be on the safer side. Okay, got it. So when I talked about the payroll level for the when you decide to go the escort route and how much payroll you should take, we use this matrix. So let's say if you got if your business made 50,000 in net profit, 40,000 above is the level we recommend. So if you're at 50,000, then we recommend about 50% of that net profit. You should take it as a W-2 and the remaining as a distribution. So as your net profit go up in the axis, so go say 100K, then you can only you don't have to go more than 40%. 150K you can drop it. So the lowest we recommend is about 25%. So let's say you have a net profit of 400K, you can stop at 100K, like 98,100,000 is the maximum amount irrespective of your amount of profit beyond the 400K. Even if it's 500,000, you don't have to take a W-2 more than 100,000. So it gets flattened after a 400K. So this is a matrix we use. So, but there are also other ways you can figure out how much should be your payroll. There are companies like RC Reports that you can you can go through the questionnaire to see what type of work that you do, what functions you spend more time, what is the salary, market salary for the work that you're doing. It'll give a recommendation of what should be a payroll. But we generally go with this matrix, which seem to be perfect and no questions ever asked by IRS. Yep, we can move on. So number 3 is if you are an LLC, if you have an LLC, you also know you can have a board of directors. So this could be you, your spouse, your kids, family members, anyone you normally can discuss business with. They can be part of this board of directors. And it's also another protection as an LLC. You want to have a board of advisors, board of directors. So it is formal. So you're conducting regular business meetings, discussing about the strategies and about businesses with the board of directors. So this only authenticates the limited liability company you have formed, and it's not just there for a namesake or on paper. So how it helps from a tax perspective is once you have a board of directors, you can plan to have meetings every month or once a quarter or once a year, and you can pick a location. Like it can be in a luxury hotel, or you can pick a vacation spot. There won't be any question asked by IRS as long as it's a legitimate reason. You are having a meeting, you are talking about the business, the financials for the year, how did we do, and what is the strategy going forward. As long as there is this business meeting happening, location or how much you spend doesn't matter. So have a board of work directors in your board, starting with your immediate family or your friends that you normally discuss the business with, so they can be part of your board. And then you can set a frequency to have regular meetings. So all expenses related to that meeting, if you do it in a different location, travel costs, dining, hotel, everything can be deducted as an expense. So this is like you're taking a vacation, spending time with your family, but you're also able to take those expenses and deduct it legitimately from your business and reduce your taxable profit. Yep. Next slide, please. So the other one is this also I see is less used by most of the taxpayers. Paying your kids. There are three levels here. If your kid is under 18-year-old, there is a process in how you pay them. And if they are 18 years or over, then they have to be either a 1099 or W2. And there's also an option where you can pay your grandkids. So if your the kids are under 18 years, and if you're an LLC or the sole proprietor, you can directly pay them. But the moment you have an S corporation, which is an entity separate from you, you cannot directly pay your kids from the S corporation. So that's when we introduce a management company, which is a family management company. Typically, it's a sole prop. It can also be a C corp in certain situation if you have a lot more. But for a small business, you would go with a sole proprietorship. Call it a family management company, and the family management company has to be owned by the parents, either one of them or both of them, but it cannot be anyone else outside. The kids' parents should own the sole proprietorship. So what you do is from your S corporation, you pay a management fee to your family management company, and from the management company, you pay your kids. So this is how you can do it, but make sure this is all legitimate. Your child is helping you in the business. I know some of my clients, kids who are 13 years, 14 years old, they're very good with technology, helping in on the marketing side. I literally saw one of my client on the Zoom meeting, and he was struggling to figure out how to turn the video on. The kid came in and helped. Then I immediately asked him, is he helping you with other aspects of your business? He said, yeah. Then we said, okay, he should be paid. So make sure that your child is really helping in your business, and then you have to keep a record of a timesheet of what work they did, description of the work, and of how many hours they work. You have to have that log, and also making sure you comply with your respective state labor rules. Like the kids cannot be in a construction site, they cannot be working in a dangerous zone. So making sure you're complying with the state labor rules, and the kids should only under 18 should only be working under the parents supervision of the parents. They cannot be working on their own someplace else. So as long as you follow all these rules and it's all legitimate, you will be able to pay your kids from your business. So the benefit of this is, one, the expense, it's income shifting. If you're in a high income tax bucket, you're able to shift your expense to your income to your kids in the form of expense. And they, even if they have to pay taxes beyond the standard limits, they're still paying like a 10% or 15%. One is income shifting. Another major benefit to paying your kids, now they have a earned income. With that, now they can start their retirement accounts from that younger age. The one we typically recommend is your kids start contributing to Roth IRA from that younger age, which is a after-tax contribution, but having earned income. It's typically under 18 is in the form of 1099. Having that earned income enables them to make contribution towards the retirement funds. So now they are building their post-tax Roth IRA from an younger age. Those are the real benefits, in addition to income shifting and lowering your tax brackets. So this you can still do by 1231, provided your child helped you in your business throughout the year. Go back and track all the hours they worked, and you can still pay them. There has to be actual payment. It's not you're not just saying on paper this is how much you're paying your kid. There has to be an actual transfer of funds from your business account to your management company, and from the management company goes to your kids' bank account. The kids should have their own respective bank accounts, and the money has to transfer to their bank account. Only then this is all done legitimately. So, but with that, like you can standard deduction, federal standard deduction for 2024 is 14,600. So, if provided your child helped you go in your business, you can pay up to 14,600 with no tax liability. You could also pay more than that; they will still be under a small tax rate. And this is only federal. Depends on your state. Each state has a different standard deduction limit. So the kid might be over the standard deduction limit for the state, in which case you will have to file a tax return for the child. So making sure you're aware of all of that. When everything is done correctly, you are able to legitimately take these deductions from your business. Yep. Next slide. Since I call next slide, Prashant. So since I explained all the documentation and procedure, so if your child is more than 18 years old, you don't have to route it through a management company. So they are now an adult, and they can be paid directly from your S corporation. You no longer have to route it through the management company. So it depends on what type of work they do. If it's contractual in nature, so the contractor versus the employee rules, make sure you go through that distinction. And if they look like an employee, work like an employee, they should be paid a W-2. If they are more in a irregular schedule or follow more of the contractor rules, then you can pay them as a 1099. So, but still, this is another way of engaging your kids in business, and then shifting your income from a higher tax rate to a lower tax rate to your kids. Next slide. So there's also paying your grandkids. So if you have grandkids, you can also, and if they are helping you, the grandparents in their business, you can also pay your grandkids and take that as a deduction. The way the grandkids are paid is not direct. They are not directly paid from your business. They have to be paid through your children. So your son or daughter has a sole proprietorship, can be a management company. So you pay the management company owned by your kids, and your kids pay your grandkids. That's the proper way to route it. And again, same concept. More than 18 years, less than 18 years. If they are less than 18 years old, they have to go through the parents' sole proprietorship. And if they are more than 18, they can be directly paid from your business on their own. Again, same concept of income shifting and the deductions. So there are a lot of businesses that we work with. Both spouses work in the business. One may be in a leading role, another may be helping the other spouse. So when it's appropriate, and when you're filing jointly, most of the time it doesn't make sense to pay the other spouse, because on the one end it's an salary expense, another end you're reporting as an income. So the only time it makes sense to pay your spouse is if you want your spouse to start contributing towards their retirement. So they want to have their own income so they can build their retirement portfolio. That could be one reason. Another reason is if you pay your spouse and they are an employee, that's another way to write off your family medical expenses. So only for these two reasons, it makes sense to pay your spouse. If these are not the reason, then it usually it's a wash if you try to pay your spouse and it's an income and expense on the other end. You will not have much tax benefit there. Yeah, next slide, Prashant. So the third one, which is very, very important at this time of the year, which is too late, but if you're maintaining your books on a regular basis, you should be closing and maintaining your books on a monthly basis. But if you haven't done any accounting, any bookkeeping throughout the year, make sure you are looking at all of your bank statements, summarizing your income and expenses, knowing where your net profit is going to land by this time. If you haven't already done it, whether you use a software like Zoho Books, which comes with wonderful features to track your income and expenses throughout the year, bank feeds and everything, or if you maintain it in a spreadsheet, which we don't recommend, So you want to make sure you know your net profits. If you don't know this by this time, you will not even know what strategies, how much more expenses I want to show in the business to legitimately lower my profitability. None of this, nothing can be planned if you don't know your net profits by now. So it just happened like yesterday. One of my client called, which whom we recommended to maintain his books throughout the year. He didn't do it, and we beginning of the year or even recently, we estimated his profits going to be 100,000. But yesterday, when he called me, he said, "Jay, we started doing our books, going over the numbers. We ended up realizing we are going to make 200,000 in net profit. What do I do?" You don't want to be in that situation, and that good that he still called yesterday, so we still have some time to make sure he is paying his spouse and he's paying his kid who is helping in the business. He's taking all the deductions, any equipment or car, anything you want to purchase, legitimately helping the business. He can still take care of it between now and end of the year. So another important aspect is, as a small business owner, if you have people working for you, if you pay them more than $600 as contractors, you are required to issue 1099 by January 31st. So, and if they are employees, or I'm assuming you're already using a payroll provider, they will take care of issuing the W-2s. But this is an important obligation by an employer who employs contractors or W-2 or employees. So to make the 1099 process easier, I know Zoho recently introduced in their platform, you can request W-9 from your vendors. You can issue 1099s from the system. So you don't have to use another software, or you don't have to miss any deadlines. So with that, I will have Purnima go over the features of Zoho. Thanks for now.
Thank you, Jayanti. Thanks for sharing these valuable tax tips to our audience today. And thanks, Prashant, for the right slide. As you rightly pointed out, maintaining accurate and organized books is very crucial for every business. And with Zoho Books, you can streamline your financial operations in addition to handling your expense banking reconciliation with the automation and customization functionalities. You can streamline your workflow. You can customize your workflow based on your unique business needs. Let me quickly go through the features that we launched today in Zoho Books. The first one is the W9 management. With this feature, you will be able to request, collect, and manage the W9 forms of your vendors within Zoho Books platform. In addition to this, the system also has a configuration which works in such a way like the system will notify you if there is a vendor missing W9 form. So this makes the whole managing your W9 form with your vendor seamless in Books. The next slide, Prashant. The next one is the electronic filing of 1099 reports. As you know, Zoho Books already has a 1099 report. With this new enhancement, we introduced the electronic filing of 1099 NEC type and 1099 MISC type of electronic filing to IRS directly from within the Zoho Books platform. With this, you will be able to do it from a single platform instead of toggling between multiple platforms. It will be Zoho Books from where you can generate and file it online. Next slide, Prashant. Fixed asset management, a long-awaited feature, I would say. With this feature, you will be able to automatically calculate depreciation, monitor your assets lifecycle value, manage disposals, and generate detailed reports, which will help you to decide, take better financial decisions. There are two methods of depreciation that is supported currently in Zoho Books. One is the straight line method, and the second is declining balance method. You can set up these rules in under the organization level in the settings, and you can replicate it for other assets. Like you can have a template which you can use it to create and use the same template for the other assets. Next slide, Prashant. Payroll integration. Yeah, so we do have a Zoho payroll which supports, currently we have a payroll which supports 20 US states. And with this new launch, we are supporting all 50 US states with more advanced functionalities, like handling overtime, filing tax automatically, employees in multi-state, and much more advanced functionalities with the new payroll launch. Next slide, Prashant. Bill pay. This feature is a very smart feature. I would say it helps you to reconcile your bills with the purchase orders and purchase receipts. And most importantly, this feature helps you to avoid overpay, that is, pay for whatever you have received. There are two ways of doing this. One is you can opt for a two-way reconciliation where the bills are compared against the purchase orders you have. And the second way is to do a three-way reconciliation where the bills are compared against the purchase orders and the purchase receipts. This feature helps to automate your accounts payable process. Next slide, Prashant.
Yeah.
And the last one to go is the revenue recognition, a long-awaited feature, I would say again. This feature helps you to defer and record the revenue as products or services. You can create rules based on different recognition methods and generate reports based out of that. Currently, our system supports three methods of recognizing the revenue. One is daily, the second is evenly distributed, and the third is evenly distributed with proration. You can create your own rules as per your need at the organization level, and you also have the flexibility to overwrite these rules at the line item level while you create an invoice. So this gives you flexibility to define a revenue recognition rule at each line item level, and it's not at the invoice level. You can always overwrite it at the line item level. And in addition to all these new features that I spoke about, Zoho Books comes with inbuilt tax features that helps you stay tax compliant and generate sales tax reports seamlessly. So we have handled with this tax configurations under settings, the Zoho Book system will inbuilt handle your sales tax handling. Next slide, Prashant.
Yeah.
You can scan this QR code and go to the link mentioned above to see the latest features of US edition of Zoho Books. And the features that I spoke all about is the features that we launched specifically for the US region. Over to you, Jayanti.
Okay, thanks, Purnima. Back again. So on to number 7, retirement, contributing towards retirement. That's another big aspect of tax planning. So there, there are several retirement products from pre-tax to post-tax to 401k, IRA, Roth. So every business owner can get really confused. And this is the ladder and the order of priority we recommend for our clients, starting from the bottom and going up in that, depending on how much you want to set aside towards retirement. So always start with a traditional IRA, 401ks, and then once you maximize the traditional IRA, then you still have more. This is based on you move up the ladder based on how much money you want to set aside towards retirement. How much cash flow do you have? Most of the time, it's a cash flow issue for small businesses. So you want to first exhaust your traditional IRA. Then next level is max your Roth IRA. Roth IRA and HSA both would be the second order. And once you maximize those contributions, then you go up to the third level, which is the SEP or simple IRA. And once this is done, then you go into the traditional 401k or Roth 401k. There are options to contribute towards that. And the last option is contributing towards your pension funds. So because any taxpayer should be taking advantage of all of these products that are out there. But again, it depends on how much cash flow that you have, how much you can set aside towards retirement. So generally, if you have a W-2 employment, you want to make sure you match your employer match contribution. So the employer is matching 4%. If you contributed up to 6%, you want to make sure to get that maximum 4%, you're maxing your contribution. So that's always the first priority, because the employer match is 100% free money to you. So if you're a W-2 employee, or even with your business as an S Corp, you are a W-2, you want to max out that strategy. And then once that's done, then you contribute towards your Roth IRA and then HSA, and set up your solo 401k and max out. There are rules how much you can contribute, and there is also income limits and contribution limits. So you want to be aware of that, and there is timeline limits as well. So make sure you are aware of these different products, how much you want to contribute, and you're maxing this. So eventually you will you will end up with a pre-tax retirement bucket and a post-tax retirement bucket. But when we work with our clients as part of our tax strategies, or though you're contributing to the pre-tax retirement, our goal eventually, before you retire 59 and a half years, our goal is to move you from your pre-tax retirement bucket all to a post-tax. This can be done through strategies by lowering your income with advanced strategies, and that enables you to do the conversion. We'll talk about conversion shortly. Next slide, Prashant. So the other expense that you want to maximize is deducting your healthcare expenses. So typically, most of the small business owners or taxpayers take advantage of the itemized deduction. If you deduct your healthcare expenses through itemized deduction, you can only deduct anything over 7.5% of your AGI. So if you had a medical expense of $1,000, but your income limit, 7.5% of your taxable gross income is already more than 1,000, you will not be able to take any of those deductions. So because you have the 7.5% limit, typically using itemization, especially when you have larger healthcare expenses, is not the ideal option. So it used to be a great way to take deductions through itemization. It's no longer the effective strategy. So instead, what we recommend our clients is make sure you are maxing your FSA, flexible spending account. And then HSA is another powerful account. There are two retirement accounts or powerful accounts. We say any taxpayer, whether you're a business owner or a W-2 or any taxpayer, should have. One is a Roth IRA, another one is the HSA. So Roth IRA is you contribute after tax money, but the growth in the Roth grows tax free. And when you withdraw it, you withdraw it tax free, provided you meet the rules. The account should have been open for 5 years, and you're 59 and a half. So as long as you meet the rules, you'll be able to take out the money tax free. HSA also same thing. It's even more better than a Roth in a way. The contribution to the HSA is also tax deductible. Versus a Roth IRA, you won't be able to deduct the contribution. With HSA, you can deduct the contribution to this account. So you accumulate the balance that in the HSA. The money you put in HSA never expires. The only restriction with the HSA is you can only use the funds towards medical expenses. That's the only restriction you have, but there is no expiration of the funds, so you can use it for any time after late retirement or your older age. So that's the advantage of having an HSA, and also the growth within HSA grows tax-free as well. So there's a lot of benefits to having to contribute an HSA. Make sure you are maximizing the HSA deduction. It does require you to have a high deductible health insurance. So it depends on your situation. If you have high healthcare expenses, may or may not be a right option, but you have to run the numbers to see if it makes sense. Also keeping in mind the longer term benefits. And the other one is health reimbursement arrangement, HRA. This can only be done through a small business. If you have a small business and it's only allowed under certain structures. So in addition to the medical insurance premium that you get to deduct from your tax return, you could also deduct other out-of-pocket expenses. Especially when someone who has high healthcare expenses out of pocket, having and you own a small business, having a health reimbursement plan, and you can pretty much have the business reimburse 100% of your healthcare expenses. And there is a catch there. If you have other W-2 employees, you will also have to extend the same benefits. So knowing all the rules and playing it safe, you can still take advantage of all of these deductions. So that's what when it comes to healthcare expenses. Let's move on. Next slide. So the previous slide was all about the payments outside the premium. So if you everyone have a health insurance premium. So you can deduct the health insurance premium as a self-employed. So whether it's paid directly by the business or you paid yourself as a small business owner. And I see most of the taxpayers miss this provision. Either they didn't tell the tax preparer, or even the tax preparer did not know about it. So as a small business owner, you are paying for your health insurance in full. You have no employer to cover your health insurance. You will be able to deduct your health insurance premium as part of Schedule 1 in your personal tax return. Make sure you're bringing this up to your accountant and taking that deduction that lowers your taxable income as well. And if you have an S corp, ideally you want the S corp own the health insurance, and you get paid from the corporation. And even if not, also even if you paid personally, you can have the S corp reimburse you and still take that legitimate deduction in your taxes. Next slide. Next slide, person.
Yeah.
The 9 and 10, more or less the same, buying vehicles and buying equipments. The biggest thing here is taking advantage of the depreciation, especially the bonus depreciation provision. So previously, if you have a car or truck or anything, typically the actual expense used to be the best in terms of maximizing your expenses, but it's no longer the case since the bonus depreciation provision was introduced. So now if you buy a equipment or a car or truck that is used in the business, at least 50% you should use in the business, more than 50% usage, then you will be able to take the depreciation and deduct it as an expense on your business. So that is a regular depreciation. Bonus depreciation is where it makes it even more juicy, where you get to take 60% of the cost of the vehicle or the equipment as a depreciation deduction in the year of purchase. If you still, between now and end of the year, if you still need equipment or legitimately can use a vehicle for your business, you can still go ahead and buy it and take a big chunk of that depreciation in your taxes in year 1. Yep, next slide. Purchase equipment goes with the same provisions as the vehicle. Both are the same. You still have that 60% bonus depreciation provision for year 1 of purchase. You need to own it. They're like, you don't want to take any shortcuts. You have your personal vehicle. You want to lease it. You don't want to do any of those things. But the vehicle has to be owned by the business. It has to be in the balance sheet of the business. Then you will be able to take the depreciation. Yeah, next slide. Oh, number 10 is the Roth conversion. This is another big one, like a lot of taxpayers miss out. Like I touched on this earlier when we looked at the retirement funds. So you have pre-tax retirement accounts and you have post-tax. So pre-tax retirement contribution, when you withdraw it at the time of retirement, you are paying taxes on it. So your goal before you retire is chunk your pre-tax retirement accounts, 401ks, IRAs, traditional IRAs, and move it from your pre-tax bucket to a post-tax Roth IRA throughout your until the year you retire. So if you try to convert all at once, let's say you have 100,000 in your traditional IRA 401k, if you convert the entire 100,000 in 2024, you will be subject to income taxes on that entire 100,000 in the year you convert. Instead, you want to look at which tax rate bucket that you're going to fall under, and then say, okay, we were doing this yesterday with a client, and then they were in a 24% tax bucket, and which, as a married filing jointly, up to 383,000 will be taxed at the 24% rate, and they were coming at taxable income of 300,000. I said you can convert 80,000 from your traditional pre-tax retirement to post-tax, so you will still be paying the 24% rate, versus the next tax rate is 32%. So if you made 100k conversion, on the additional 20%, you're paying 32% in taxes. So planning that early on with your tax advisor, and looking at where your income is going to land and how much you want to transfer. You should be looking at this every single year and planning and deciding how much you want to convert every single year. So that's how you will end up with the tax-free money by the time you retire. So there is for the conversion, there is a deadline too. By December 31st, you have to do the conversion. You will not be able to do it for later. Yep, next slide. So this is another one. I think this is typically most of the business owner know about it. But before December 31st, make sure you are prepaying your expenses, assuming you are a cash basis taxpayer, which pretty much all the small business owners under 10 million in revenue are. So you want to make sure any expenses you think you will pay in January, you could prepay it now and still take it as a deduction. All of this strategy only applies if you think that you're going to have a huge taxable profit in your business. So then you could delay some of your income coming in from your customers. If someone is going to pay you towards the last week of December, you can tell them to pay in January, so it gets shifted to next year. But it's just not pushing it to the next year while planning this. You want to make sure, is this the year I'm going to have more profit, or is this next year? So if you anticipate your next year profitability is going to be less, then it depends on where you land. You want to strategize between this year and next year based on which year is going to have more profit and where do you want to show more profit, and depends on tax rate. You can play with that, but you cannot just blindly do it. No, make sure you know what's the net profit is going to be for this year and also next year. Do I want to shift or not? But all of these strategies help. One biggest thing is so to make the prepaid expenses, it doesn't have to be actually paid. Even if you made a purchase using your credit card, as long the credit card you will be paying when the statement arrives, you will be paying a month later. But as long as you used a credit card to make the purchase, the transaction date is still within 12/31. You can still take that as an expense this year. So that's another one a lot of people miss out. So if you don't have the cash flow to show more expense this year, but there is something you still want to spend, put it on a credit card and you still be able to take it this year. You're not impacting your cash flow. Yeah, next, last one. Number 12. So this is about charitable contribution. There's two slides here. One is a non-cash contribution and a cash contribution. So if you made donations or charity or use volunteered, as long as the value of that charity is less than $250, you don't need any documentation or receipts. But if you your non-cash contribution is more than $500, you also have to go file a form 8283. You could also donate car, boat, whatever assets. If you want to go donate, you can donate it as an asset rather than selling them and paying in cash. That's also the next one. Prashant, you can go to the next slide. So if you want to donate to charity, and if you have stocks, you want to donate the stocks rather than selling the shares and taking the cash and donating at cash. What happens is, if you have a share in a company and then it appreciated, and if you sell it and take the cash, you will be subject to the capital gains tax. When you sold it, you took the money and then you donated it, you still pay capital gains taxes on it. Versus if you donated that stock directly to the non-profit, which most of the non-profit very well know, they will they have a brokerage account, they will take the stocks and they will go and sell it. Then you still get the benefit of the cash value as a donation, and you are not paying any capital gains taxes on that. So that's another way you got to still have a donation deduction this year and not subject to capital gains taxes. And to take the donation contribution, you do have to be itemizing, but check is if your standard deduction is better versus itemization, and then make that decision, which makes better sense for you. So that is all I had for now. Next slide. Thanks, everyone. There are so many other strategies, but we try to cover within the limited time of 12 strategies, which you can still, between now and end of the year, which you can still do. That's what we covered here. But obviously, there are about 1,500 tax saving strategies we analyze for our clients throughout the year. We start early in the year planning for it and help our clients implement it throughout the year so they can realize the savings in the tax return. The key is knowing all of this is fine. You will only save in taxes only if you implement it and show it properly in your tax return. So all these stages are important. Implementing it is a challenge too. And even if you implement it, if your tax preparer did not report it correctly, you are not going to get any of these benefits. So making sure you follow all the way through and realizing those savings in your tax return is key. So and if you have any still more questions for this webinar, I provide a free consultation. You can find me on LinkedIn. There is a LinkedIn link here, and you can book a free discovery session with me. You can scan this Calendly link and book a meeting with us. Make sure when you come for the meeting, bring your 2023 tax return, your full year 2024 financial, and if you still have not closed the books, an estimate of the profitability, so we can have a better conversation. That's all. Thanks,
Thank
Prashant.
you very much, Jayanti.
Anyway.
It was very, very insightful
Yeah.
as reflected the number of questions we have received. Before we
Yeah,
wrap up the session, do you quickly want to take some of the questions? There are quite a lot of
yes.
them.
Let me check recording. So, okay, so I have a small board. I can write off the whole trip, even if it's just me and my wife. Yes, yes, you will be, as long as you and your wife are listed as board of directors in your LLC registration with the state, and you have in the form of your operating agreements, the board members are included. And yeah, even if you both take a trip and discuss business, you need to have a business purpose for that vacation or a trip that you take. So there has to be a business purpose. You discuss business, have minutes, and a strategy or follow-up action. So you need to have those minutes and documentation when the meeting held. So as long as you follow all of this, you should be able to take the entire trip as a deduction as part of the board. Do you recommend switching the LLC to manager managed by the board? So this is a different scenario, like when manager managed. So there are, if you have an LLC, there are two roles as a business owner. One is a manager, another one is a member. So typically, member is the one who has the ownership of the business, who is subject to all the tax liabilities. Manager is someone either you act as manager or you employ someone to be acting as a manager where you pay them a salary. So this comes into play when you want to treat your business as a passive or active. So we work with our clients on some of this. And if you really are like remotely involved in the business, you take a passive role. You want to appoint someone as a manager who can make decision. In that case, your business activity can be considered as passive, which can help if you have more passive losses from other activities, typically real estate. So that's where this manager comes into picture. But I don't know what from what perspective you're asking the question. On the next one, the LLC ownership could be split between mom and dad, then pay kids. Yes, so the management company, it can be owned either by mom or by dad or both. You just don't want anyone else outside. It can be either one of them or both of them. And is this escort or taxed as? Yeah, I covered this. So you don't want to go and form a direct S corporation. You want to have an LLC, and then only want to be taxed as an S corporation from IRS tax perspective. That's where you file Form 2553. So it's taxed as an S corp. It's called a S corp election. You don't want to directly form an S corp, which requires additional filing requirements and everything. You don't need that. Yes, so Kenneth, yeah, we will share our, I think we shared our, you can connect with me on LinkedIn or book a
You
call
also
with
drop
us.
the links on the chat, both Jayanti's and Purnima's LinkedIn links as well as Jayanti's meeting link.
Okay. Okay, Zoho related, I'm assuming you guys
Yeah, one
answered.
second.
Or do you have any thoughts about using a PEO for better health insurance cost, even if I have one person business? Yeah, PEO, yes, the biggest reason people go for it, you get to access a group benefit, which you will not be able to do as a one person company. So Yeah, there are benefits to it. Yeah, you want to be careful. You want to see the pros and cons, but there is a benefit which primarily comes from a group benefit. What are the contribution limits for S Corp employees? Can S Corp owner still open and contribute to IRA or Roth? Yeah, of course. So Roth contribution, as long as you have a earned income, you can contribute. So whether it's a W-2 or you as an S Corp owner, you still have a W-2. And yes, as an S Corp owner, you can also have a solo 401k or a SEP IRA, but depends on how many employees do you have, how many part-time, how many full-time, how long they are with the business. So whether or not you have to extend the retirement benefit to the other employees as well. So you want to know the rules, and if you're not touching the limits of full-time employees, then you can, for a period of time, you can still have your solo 401k and only contribute to your retirement and not offer to employees. So all that options possible. What is the minimum usage of the vehicle? 50% minimum used in the business to qualify for the vehicle deduction. If it's under 50,000, it's disallowed. The backdoor Roth accounts are going away. No, this was the discussion during election time. It depends on who is going to come into the power. So yeah, so this was it's no longer the case. So, and we don't think backdoor will go away given the presidency we have now. So yeah, it was a conversation, but there's no rule right now. I'm 66 years. Is there any benefit to a Roth? No, it depends on yeah, Roth. You like it depends on if you have a W-2 income now. So, are you working? Do you have a W-2 salary? Do you want to save your taxable W-2 by contributing to yeah, Roth? It depends on your situation. I need more information to answer that. You can run calculation to determine if keeping dollars in your traditional IRA with the annual RMD, yeah, will cost more over the long run than covering a portion to a Roth and taking the one-time hit. All depends on your, yeah, correct. I think Greg partially answered it. You need to elect to run your books on an accrual basis. Oh, for the, I think the depreciation you're talking about. No, depreciation is one exception. You don't have to be an accrual taxpayer to take the depreciation. A lot of people don't know this. So good you asked about this. If you elected cash basis, it would not apply. No, it will apply. Depreciation does. You don't have to be accrual tax. But for vehicle, can cash basis is fine. Recognize income when you receive it and expenses when you spend it. Oh yeah, someone. Okay, I think express spend. Any other questions I'm missing? What if my company has failed to keep books for the past 2 years? So you do want, because you will know your profit only by having your books organized, right? Otherwise, how will you know how much you earned, how much you need to pay taxes on? Yes, books are critical. We have an LLC with only foreign non-resident owners. Which declarations do I have to file? We found it this year. Foreign LLC, foreign owners with LLC. So yeah, with as long as it's an LLC, S corp has a restriction. You cannot have non-resident owners, but LLC, you still, the foreign members have to have an ITIN, and they have to file their non-resident taxes. So yes, so the foreign owners have to apply for the ITIN and then file tax returns. But if you're an S corp, you cannot have a foreign owner.
Then there are a couple of questions on the Q&A tab. There's one like, how can one transfer college tuition to an LLC? Is that possible?
How can one transfer college tuition to an LLC? Is that even possible? No, I don't think it's no. You cannot track. So the mention of the college tuition came from paying the kids. So when you have your kids help you in your business, you can pay them, and then they can pay their tuition fees. So there is no way a business can pay directly for a college tuition. How can one transfer? Okay, how much do you have to use a vehicle to get the benefits of buying a new vehicle by the year end? Yeah, so yeah, even if you bought it now, like even if you bought it on December 31st, As long as you on that day you used more than 50% of the business, it does qualify. So it's the usage, like average usage throughout the year. You bought it on 12/31. That's that one day, and you used it all day for business. That qualifies. That's it. That's all
Right
the questions
then.
I see.
Yeah.
I missed.
I guess we have answered one. There's one from Derek though. Not sure if that was taken. Derek asked like the business is doing a revenue of 10K per year. Could he do an HRA?
Oh, for the HRA, would that apply even if you have a low revenue business? Yes, about 10K a year right now. So could I do an HRA? Depends on the LLC, the structure of your business. So for a HRA, you cannot do it directly through an S corp. You have to route it either through a management company or a C corporation. There are times where we set up under an S corp a management company, which is a C corp, and then from the C corp you employ your spouse or kids and have your health insurances covered from there. Yeah, the income, there is no income limit. It's how legitimate it is, and are you an employee working in the business to earn the income? All of those matters. There is no income. Yeah, just make sure you're not showing losses because of that. So yeah, just be cautious in opening up yourself for audit. But other than that, I don't see any income restriction.
Got it. I guess we have pretty much answered all the questions. Thank you very much, Jayanti, for delivering all your
Okay.
insights, and thanks, Purnima, for quickly giving an overview of Zoho Books. I'm sure our attendees found it very, very insightful.
Sure.
And thanks to all our
Thank you.
attendees for an engaging and all those thoughtful questions. We are pretty a bit over time, but I'm sure you guys found it very, very insightful. We'll be sharing a recording of this webinar right after this meeting within an hour or two. And I'll also be sharing the links that Jayanti had shared. So if you want to book a meeting with her, you can use those links and get in touch with her or Purnima. So thank you very much. Take care. See you all. Bye-bye.
Thanks. Thanks, Purnima.
Thank you.
Thank you.
Thanks, everyone.
Thanks, Jayanti.
Bye.